Good morning, everybody. Welcome to the Trading Market Technicals morning call video for Tuesday, August 28th. Markets ended up the day flat, but prior to that, we did have a little bit of a move up into around 11:30. Top line around 14.16 in the cash. This is a 5-minute chart, and basically grinded lower with some selling pressure coming in at the end of the day, closing at its lows. Ended up flat on the day. I do think that most of the week is going to be a benign event, mostly because we have a big Ben Bernanke Jackson Hole speech coming out noon on Friday. I think that it's going to be a positive speech going into the election. I mentioned yesterday how Mitt Romney, if he did get elected, would not be hiring Ben Bernanke. So he's looking to keep his job as well as Obama. And talks of QE3 with the letter distributed last week, who took back statements from the non-Fed member Bullard, who said that QE3 is not necessary. The economy is improving. And Ben Bernanke stated otherwise. So the markets are basically being tugged on any kind of news-driven event. So that does trump the chart. So that's why you got to use caution here, especially on low volume. S&P, the SPYs once again had the lowest volume levels of the year. So conviction definitely is moving out of this market. That's for sure. So we peaked late in the morning, and then we started to roll off. Now there are some key events coming out this week, and like I said, I want you guys to be aware of that. We have the consumer confidence coming out today. That's a big event. We have Merkel and Monti from the ECB meeting on Wednesday, so that's going to be something to look for. On Friday, we have the Chicago PMI, as everybody knows, and then of course the Jackson Hole speech. And then we have Chairman Draghi from ECB Chairman on Saturday, and August China's PMI comes out Saturday as well. They release it every Saturday of the previous month, so that's something that's going to be very interesting. Last night we had some really poor Japan numbers that actually took the markets down, sold off the Aussie dollar as well, and the S&P, and now we bounce back up again to be +1. So lack of conviction to the downside. Markets are still hanging in there, but I keep saying for the last 3 weeks, 4 weeks, use caution because the markets are very dangerous here at this time. And really what you want to look for is key events on certain stocks that can give you some volatility to trade. Other than that, just going to get chopped around. Breakouts are going to be non-existent this week. They're going to basically ultimately fail. So you want to just, you look for stocks that have some sort of a news, upgrade, downgrade, and try to play them accordingly to your risk tolerance. That's going to really be the best way. Other than that, really stay in cash and stay on the sidelines until the market picks up some volatility. Because this week really will be a non-event. And the only factor, again, is going to be the headline news that I just mentioned before. So let's get into the charts. I want to show you some specific stuff that I've been looking at, and really now looking at how I see that any little negative news here, I think a pullback is going to be imminent, and I think it's going to be come quite quickly. Now, even if Ben Bernanke talks about QE3 and additional QE3 measures, I mean that might spark a little bit of a rally, but I don't see this market going any higher until we get some sort of at least a small correction. Market can't just continue to can stay up here. Now, it can stay overbought. Overbought is not a sell signal. Oversold is not a buy signal. So just please be aware of that. So we want to really stick to the trend accordingly, trade accordingly to your risk tolerance and your game plan. All right. So now let's take a quick look at that 10-minute chart of the SPY spiders. As you can see, look at the volume here. Total non-event. And we actually capped here. We filled that gap here coming back from last Thursday. On Friday, and we did pop up, and then we just rolled right back over again. So really no conviction either way. So that's something really to kind of think about and digest. Now I want to get into the indicators here, and I wanted to show you guys what we're looking at. Now our bar chart momentum indicator, I haven't showed this in a while because really nothing has been happening. As you can see, the last couple of weeks we've been really sitting at between 99.50 and 100. Anything above 101.5 and 99 and 98.5 really gives you some overbought, oversold reading. So really, this has not shown anything other than the fact that we could move higher and or lower. There's some major room here. Same thing with the NYMO. Wanted to show you the NYMO here. As you can see, we've been really stuck in this range from the middle of July, and we're really just really sitting here doing not much of anything. So if the market wanted to rally or sell off, we have plenty of room here to really get to the extreme levels here of negative 100. So that's something that I would like to keep you guys keep an eye on. Now, I always show the copper, right? Because copper really, guys, is important. You should look at copper during the day as well if you are day trading. We have this little doji star here. We have a lot of indecision candles here, right? We have dragonfly doji, spinning top. We have another doji here. So, but we're capped at this trend line here. And this trend line here is really showing that copper is very weak. It's not, hasn't really led the markets when usually copper does lead the markets. And even if it does, we have a 355 area. Then above that is a 200-day moving average. So that in itself is going to be heavy resistance. So I don't see much copper unless it does play catch-up, which I've seen many times. But this is something that really keep an eye on as well. Now the VIX is really getting interesting. We are at here at a double bottom, right? We had this bullish fallen wedge. We did break out, and then we rolled right back down again. So this really failed, right? Because usually we want to keep it right about here and then start to move higher. So this bullish fallen wedge really didn't amount to anything. It failed. But look at what's happening here. Markets actually were rallying while S&P, while the VIX was still up. Now this happened a couple times already. So there is a little bit of feel creeping up. So with market participants, investors, traders are starting to buy puts because they're cheap. Volatility's low, so it's a good time to be buying puts here. And again, like I mentioned weeks and weeks ago, if you are long and staying long on your investment account, now's a good time to buy some insurance, some cheap insurance, and buy some puts on the market. And then you can weather the storm, and you can continue to stay long through a correction. Okay, now. This is something I'm going to really keep an eye on here. Now, I'd like to see this clear this little gap lower, and then anything really starting above 18, 19, 20, we can get outside the band here. I think you're going to get some further increase. Now, keep in mind about the VIX. Now, I want to show you bonds. Now, this is a daily chart of the 30-year Treasury Bond Index, and I put the bullish fallen wedge on here a few days ago, actually last week. And I put this long-term uptrend line. And if you could see here, this long-term uptrend line held as well as the 150-day moving average. And you see how we're starting to creep back up again. Now, this is a normal process. After having a large move, we have a little bit of retracement lower. So this, to me, we are at support, and we broke out of a bullish fallen wedge is bullish. Even if the market came back in again, because usually when a bullish fallen wedge breaks out, you get a little bit of a pullback and then a move higher again. So the VIX at a decent area here to rally. Now watch this. The bonds are looking really well. Now, weekly chart of the bonds. Big long-term uptrend line from March 2011 all the way right now to 2012. Pull back right up in here into the 20-day moving average. Held the 20-day moving average for the last 4 weeks, and now just starting to rally. Okay, bonds rally, VIX rally, market sells off, okay? So just keep that in mind. Now, I want to get into the index charts, and I want to show you what's really concerning, and I've been mentioning this for a while now, but if you look at the S&P daily chart, right, we are at a double top situation here. We've been really moving higher up in this. We did pierce to the 1426 area, and then we roll back down. We're above this bearish rising wedge here. Excuse me, let me just move that right over. Okay, so we're above this bearish rising wedge, and now we're just kind of hanging around here. Normally this is bullish, right? When we get hang around the top looking for a breakout. But look what's happening. Our momentum indicators are rolling over. So any breakout really is unsustainable unless you have a major event that's going to spark and fuel another rally. Now that could be the Jackson Hole speech. Really Ben Bernanke coming out clearly stating we are going to pump a ton of money into the economy, and then that would probably propel us to the 1460 area, 1440, 1460 area from last July. So let's just keep an eye on this. But right now, this is telling me that the market's very weak. We're rolling over. Our indicators are rolling over. Now this could stay here. Okay, it can stay in this area from the chop around another week or so, and then our indicators just unwind that overbought reading, and then we can move higher. So that is still possible. I'm not telling everybody to go out and short the market here, but I want to just be prepared And even if the market does roll over and starts a new leg lower, there's going to be plenty of time to short stocks. Now, here's the SPY, and I always like to look at the volume. Look at yesterday's volume. It was anemic. It's just absolutely ridiculous. And because of the fact that we are at the last week of the summer, so it is to be expected, but really, really weak volume. Now, we have this double top here again, okay, and we're starting to just roll right over here in the spiders. And I like to look at this with the volume. Now, IWM's Russell, as you know, a good gauge of risk. Volume lower again here. We've been low with this volume since the whole month of August so far, and we're just kind of just jumping around here above the 20-day moving average. Kind of constructive. Not really much to talk about here, other than the fact that we started making lower lows, and then now we just kind of popped up, or we kind of reversed course on the IWMs. But this is one of the other few areas of interest to me, which tells me the market is peaking. Of course, the bonds and the VIX, as you know, at critical areas of support and looking to bounce. Now we have the transports. Transports did make a little bit of a rally here, as you can see, but look what happened. We're above the 20, we're below the 20, the 50, and the 200-day moving average, and looking lower with a large engulfing candle. I understand. I've been telling that, look, guys, this transports looks really terrible. Well, this does not look good at all. And at one point in time, the market cannot run higher without the transportation sector. Okay, and of course the banks and some of the tech stocks, but banks have been doing really well. This here can take everything else down, so just keep that in mind. This is the leader of all indices, and if this can't rally, well, the market's going to, at one point in time, is going to follow suit. Now, I don't know when, but I just want you to know this is a big red flag. Another red flag is SMHs. Now, as you know, with the semiconductors definitely a risk-on type thing. We have been making lower lows in the SMHs here, where, of course, the big cap tech has been rallying. Of course, Apple, they won that verdict, so we made a new high. And Apple is, I think the Qs sometimes are skewed because what Apple does is highly weighted. But if you look at the semiconductor index and you look at the stochastics and the MACDs, they are producing sell signals. And we do have some divergence between the technology sector and the semiconductor industry. So that's something that really is that poses risk here to the markets. Now, I'll show you big cap tech, and I mentioned the double top formation, if you remember. This is a weekly chart. So this is from last week. We created a doji. Yesterday's volume now. Okay, now this is a weekly chart. So this candle really doesn't count until the end of on Friday. But if big cap tech cannot clear this double top and continue to rally, this market will sell off, along with the transportation sector and what bonds and the VIX are doing. So we really need to keep an eye on this. And again, the sell signal would be 67.45 in the Qs. A break lower in this on a closing basis would put this sell signal on his double top. And usually on a weekly chart, we see a double top, we want to start selling a double top. Okay, now we don't have confirmation yet, all right, until we take out this doji candle, but that 67.55, 67.45, excuse me, that would tell me that that the markets are in trouble, especially when you have big cap tech. And then the daily. Lastly, a daily chart of the Qs. As you can see here, double top in the Qs as well, and a break below in this area here, this little consolidation area, would at least get it down to the 20-day, if not the 50-day moving average. So a lot of warning signs. A lot of complacency in the markets, and again, anything can happen. If Ben Bernanke has that positive speech, the markets will go higher, no question about it. Now, is it priced in? That's something that we need to see. We don't want to have a positive speech in Ben Bernanke. We want to see how the markets react to Ben Bernanke's speech. That's going to be real critical. And of course, we have the China PMI coming out over the weekend. Now, China is deteriorating at a rapid pace. Everybody was stating about how China's having a soft landing. Not so. That's not going to happen. They will have a hard landing eventually, and what's going to happen is going to put real pressure on a lot of these risk assets as far as commodities and the risk and the commodity currencies as well, if people are following that. We started lightly dipping our toes in the commodity sector with the Euro Aussie. That's going to be a continued play of looking to buy dips as far as that's concerned. But again, has not we have not 100% got into that because we still, all eyes are on Europe and what's happening with the Eurozone, but that's clearly starting to fade with the ECB starting to grab hold of the situation. Once that happens, all eyes will be on the world's second largest economy, which would be China. and that's going to happen, and that's going to really hurt the economy as well as our stock market as well. Okay? All right, guys, a little longer than usual, but I really wanted to get that point made. Have a great day trading today. Again, use caution. Be careful. Markets are really dead here. We don't have a lot of market participants playing, so the best thing to do is really step aside, take a few trades, see if you can grab a nice trade here and there. If not, remember, cash is a position. And we'll talk to you tomorrow. Have a great day, everybody. Be safe out there.